From one retail investor to another. This is Trader72. Welcome back, guys, to my YouTube channel. And I hope you are all well on this fine week. It's already whizzing by, and we're already coming to the latter part of the week. Where does the time go? Well, I'm back. I'm back for this time an analysis on a specific company, and it is Alibaba. Yes, Alibaba, it's not just an e-commerce, which a lot of people do see Alibaba as. It's more about a complete different facet of the company, different various facets that we're looking at here. We're putting back the curtain on the risk versus reward ratio of Alibaba. So skeptical about potentially investing in them due to various different circumstances we'll go into at the moment. But is it worth having in your portfolio? Is the company sound? Are the fundamentals lining up? And is the share price at good value? That's what I'm going to decide to uncover today for you guys. It's been one that not a lot of people have done so far. It was pretty much talked about when it first floated as an IPO about 10 years ago, when myself and my dad, when we first traded, did buy into. And it did turn sour because of various different reasons, specifically dealing with the Chinese government there, or what we call party there at that time. And obviously there was different regulations to potentially what we're used to in the West. Now, this is not about a political chat. This is more about the stock itself and where it's at the moment. Obviously, it does flow on the US market, but obviously governed by its home country, clearly. So let's, without further ado, break down Alibaba, guys. So as we can see here, let's first of all, the main thing is the 4 M's, which is understanding the meaning of the company. What does the company do? Now, I know I keep harping on about the same old thing, but the meaning of a company is all important. It is very important that before you invest, you guys understand the business. If you don't, and you can't explain it to a 15 or 10-year-old, what the company does, what is the point of investing? You need to understand the basics of any company you invest in. If I don't understand it, I don't invest. That's as simple as that. And that's one of the rules I've learned from, again, Rule 1 book, which you guys I've mentioned many of times in my last episodes. It's very important that you have some kind of idea of what it is. Now, I'm not a financial advisor. I have no financial background. So this is purely advisory, just kind of a little tick here in terms of reminder. So you guys need to do your own due diligence on this and find out if, this is what you want to do. Obviously, there's different types of investing. I'm in the middle ground of a value investor / medium investor in terms of buying in and out of stocks. Sometimes I can be for a year, 2 years, 6 months, 3 months, 2 weeks. It really depends on the circumstance and where I see an opportunity. Now, at this moment in time, it is important that the first part of whatever companies I look at, I understand the meaning, the moats, which is obviously something we need to understand where the market is in terms of, is it a dominant market company, a network effects as well, of course, which is important. And then understanding the fundamentals, and then the understanding of the share price and its value as it is, as an intrinsic price. So these are the key points that I think any investor should look into before investing. It is a lot of research, it is a lot of time, but it is important that you obviously put your money in a company that you believe in and you got it at the right time. Remember, guys, it is all about the history of the company, the story of the company versus the share price. If the two meet, potentially it is an investable company. So let's break down Alibaba. Alibaba was obviously founded back in 1999 by a chap called Jack Ma, who obviously started it after quite a few failed businesses, and in the end became a billionaire with Alibaba. Alibaba is predominantly obviously an e-commerce business, very similar to Amazon, I suppose, in a way, probably as big as Amazon in many ways, maybe some even say bigger. And it is obviously e-commerce and technology. So what do they have? They have commerce, which is obviously, most of you have heard of some of these companies. Taobao, which is China's leading online shopping destination. Tmall, which is premium unique marketing place for brands and retailers. AliExpress, etc., etc. There, it's all there for you guys to have a peruse if you want to. It also is now got a cloud and technology, which obviously a lot of these e-commerce now had to invest in, as we know, with the amount of capex going into AI and cloud at the moment, Azure, AWS, and so forth. So same for Alibaba in that respect. So you've got Alibaba Cloud, obviously, which is the number one cloud service provider in China and pretty much around the world. AI analytics, of course, enterprise services, and Quark. So very similar to what we are looking at the moment with the top 7 mag. International digital commerce, so it's enabling global trade and connecting brands and consumer across borders. AliExpress, again, global marketplace. You've got logistics network and, of course, a digital media and entertainment. As you probably, some of you may have noticed, Alibaba has put a lot of money into feature films and obviously subscribe, obviously streaming services. And you can see the name Alibaba on a lot of big action movies, etc., etc. So you got Alibaba Pictures here, production, distribution. You've got online video platform, which is Youku. Damal, leading entertainment and ticketing platform. So it is really an Amazon, really, in China. But as I said, probably even bigger in that respect. It also has a combination of maybe a bit of Google, Microsoft, and so forth. So really, it's a cloud computing, AI data intelligence, payment fintech as well. Alipay, obviously, which is obviously a big part of it. And really has over 1.55 billion actual active consumers. I mean, it is a staggering amount here. Commerce, cloud and technology, international digital commerce, Kenyo's smart logistic network, and digital media entertainment. Has obviously over an incredible amount of people working there. It is based in Hangzhou, China. And as I said, Jack Ma was the initial co-founder. Now, there's been question mark whether or not he's still around or not. I'm not going to get into politics on that one at this stage, but it certainly is a new owner running that business. So total revenue here, guys, is effectively, as it whole at the moment, total revenue is between $13.8 billion. Now, this is obviously right up to date from March the 31st, 2026. Obviously, there's been another quarter since. So this is more of an overall picture of the numbers more than anything else that I've gathered together. So let's break it down. Total revenue is 13.1 billion, 6% year on year up. Operating income is 18% year on year up. Net income again, 16%, very impressive, 1.70 billion. Adjusted EBITDA at 30% year on year up. Again, active consumer is still on the up, considering that the business has been around. There is going to be a plateau at some stage. It employs over 51,000 employees, which is pretty outstanding in terms of certainly not a small company. So breaking down the business, exactly as you can see here, we've got innovation initiative in orders, which is 35% of the income, followed by international digital commerce on 22%, and straight after that, really cloud intelligence on 13%, and so forth. So you can see the numbers there. So the Tabo and Tmall, China's leading online retail platform, is a revenue of 3.76 billion, so that's 5% year on year on. AliExpress, Lazada, Daraz, and Trendyol is again up 22% year on year at 1.4 billion. Local services as well. So it looks like most of their departments or various different wings of Alibaba is on the up for sure across the board in terms of revenue. Interestingly enough as well, the Alibaba Cloud, which is the number one provider, serving 87 of the Fortune Global 100, which is I think quite an important part. So obviously big clients use Alibaba. Again, up 13% year on year at $2.40 billion. So it is actually the number one cloud company in Asia. Again, competing against that side of it. I don't think there's a lot of people compete against that. Top 10 commerce company by GMV. And basically Alibaba is that global leader in e-commerce. So as you can see there, the financial performance is again pretty good year on year. We're looking at 12.9 billion in 22 to now 13.181 billion by 2026, with a net profit of 1.5 to 1.7 billion. Now, it's not a staggering movement up from year to year, but it is still, at the size of that company, it's pretty good nevertheless. Free cash flow is also something that we will look into in a minute, which is again up year on year, and certainly very impressive numbers in terms of the breakdown. So just to give you a quick look on the ecosystem of Alibaba, again, I'm just going through this very quickly. This gives you an idea, again, very similar to, again, apps that they have or they own across the board. Smart device, hardware, Tmall Genie, smart speakers, Quark, smart glasses. Again, it's the expansion is just unfathomable, really, in terms of where it's going. It is really a one-stop shop, and I hate to call it because it's quite crude calling it this, but really a one-stop shop company, really. It goes across the board. It's a bit of a Meta, a bit of a Google, a bit of an Amazon, all in one. So again, a huge conglomerate, really, and it's becoming bigger and bigger as they go. Smart terminals, Alibaba Cloud again, but it also has design tools, as you can see there. The global shopping side of it, Alipay as well. And manage and grow business, entertain and discover, so it really has tentacles everywhere. So again, just to give you guys a really clear all-around picture of what Alibaba does and where its tentacles go to, which is pretty much every aspect of the business, but combined as one company. Bull and bear case for Alibaba. Now we're getting to the juicy bits now, guys, in terms of understanding the business, in terms of the pros and cons, which I always like to look for when I invest in a company. There's always a good and bad to everything. So let's start with the bull case for Alibaba, and it obviously has some compelling points. Obviously, it's core commerce and strength, monetization. Taboo and Tmall remain China's number one commerce platform. It's expanding into cloud intelligence, growth engine, as we've just discussed. Alibaba's cloud is Asia-Pacific's number one cloud provider, and we know that China is a huge market with the amount of people they have there, amongst other Asian markets within the Asia area. AI and technology leadership, heavy investment in AI, which obviously every company we know is investing heavily in AI at this moment. AI-driven efficiency across e-commerce, international commerce momentum, AliExpress, Lazada, Tmall, again, a huge amount of stellar business there. Logistics, local services scale, Cameo network, global logistics, and obviously, so that's where they go. So China consumption recovery boosts e-commerce advertising. It has a massive cloud and AI monetization drive high margin growth, which some of the other companies may not have done yet. So the monetization of the results of their expenditure in AI is clearly working. International expansions unlocks new growth. Share buyback is something that we need to look at in terms of whether or not they bought at the right time. I think that share buyback is always the best when obviously the stock price is at a low, not at a high or medium size. So that's obviously the prerogative of the company, but I think that the more stocks you can share, buybacks you can do when the share price is cheaper is better, as we've well discussed before. Now, the bear case for Alibaba. Macro and consumer weakness in China is obviously a bit of an up and down. We have known this. Sluggish economic growth can affect the business. We know that the Chinese have a very strong economy, but it is can be seesaw sometimes, so that can actually have an effect. Lower spending could pressure GMV and revenue growth. Intense competition from JD.com and Pinduoduo. Yes, that also has been an issue in the past. And a price war could also affect Alibaba in its profit, and its bottom line. Regulatory and geopolitical risk, ongoing regulatory uncertainty in China. Now, we know that the Chinese have in the past slapped a few fines on Alibaba for various different reasons, and there's been issues there, which I'm not going to go into too much because that's more political. That's not my job here to do so, but there is uncertainty from that side always in the background of any investor, and I think that has affected Alibaba's share price on and off, although share price was on a tear for the last few years, but I think it's been now slightly China's political side side has taken a seat back and let Alibaba grow in its going forward. However, still that is always so. US-China tension could affect a cross-border business. Now we know that that's always an ongoing between Trump and Xi, so that is obviously another issue that can happen with various different chats between the two big superpowers. Heavy investment in AI cloud and international markets, near-term margin pressure on ROI. Now, again, this is something that I would probably agree with. That could be an issue as well, because obviously we've seen that now with the Mag 7 spending a tremendous amount on AI capex, and I think there is no different there with Alibaba in terms of the expenditure into the AI market. So therefore, that's something that maybe you guys need to have a look at as well in terms of expenditure and how much they're spending and how much is that affecting their free cash flow, which is obviously the lifeblood of the company. But we know from other Meta and Google and so forth that they are spending a heck of a lot on their capex, and it's starting to affect their free cash flow. So that's something to definitely be aware of. Expanding globally is a complex and costly. Local competition strong in the markets. That is also potentially an issue. And obviously the valuation of the stock, which we'll come to that in a minute. So yeah, I think there is quite a few, good points on the bear case. To be aware, to balance obviously the proactiveness of Alibaba into certain markets and how it's globally really owning a lot of the markets. But on the other hand, like any big company, there is obviously the risk of macro intense competition, regulatory issues, investment and profitability pressures from competition. So looking now at the numbers just below this, just going to give you a quick recap. Market cap is the first thing I look at, 319, which is what the company's worth as a whole if you were to buy it tomorrow, versus enterprise value, which gives you an idea of the actual net debt that the company has. And as you can see, there is a little bit of debt there from 346 to 319. So something to obviously bear in mind. But a company of the size of Alibaba always has some kind of debt. The question is whether or not it's manageable. That's something we need to probably look into more. Free cash flow is currently at 22 billion, up from 19 billion on a 5-year average. So that is obviously something very positive. And also revenue up at 130, net income at 18 billion. Average company ratio is currently at 16. It has been around the 18 to 20, so definitely slightly cheaper at the moment. PEG is at 0.68, which does make it cheap. Anything under 1 is supposedly quite cheap on the PEG. Again, something that to bear in mind. Profit margins at 14%. Again, the profit margins that have shrank or moved up slightly from a 10-year, but down on the 5-year. So again, this is something that you guys need to have a look at. Gross profit margin is still decent at 34%. Not maybe in the territory of some of the big Mag 7 in the past, or even some of the SaaS companies that I've looked at, which was about 60 to 80%, but it's still decent for a company of its size. And revenue growth is compounded from at 3.6, down a bit up from 2.2%. It is, total acquisition in the past 5 years is 20 billion, which is quite a bit. So they've obviously clearly bought quite a few companies on there. My other issue really is the return on investment, which you guys, I like to have a criteria of minimum of 10%. And it's currently at 8.6%. So it's quite low, the return on investment for me at this moment. But again, you've got to kind of weigh things up in terms of the size of the company, the revenue, and the outgoings of the company and what it's making. But 8%, I would say, is a little bit on the low side for me. Discounted cash flow model. Now, this is when we really get to the nitty gritty of more on the share price. So we've looked at the numbers. They're pretty good. The business is humongous, very positive. Yes, there's pros and cons so far, just to recap. And it certainly is a quality company with quality fundamentals, although there is obviously slight discrepancies in terms of maybe some of the numbers over the last 5 years, maybe to have a further look at. But now, is it at this moment, is the share price at the moment overvalued or undervalued? I think that's the most important thing. Now, I know that the share price of Alibaba about a year ago was around the $90 to $100 mark, and it was certainly undervalued. And as you will see here, based on a 2% growth, which has been quite conservative, It gives us $127 intrinsic price. The current price at the moment of the share price is at 132. So in my estimation, based on a 2% with an 8% discount and a perpetual growth rate of about 2 to 3%, which is roughly GDP average for the US beyond the 10 years, as you can see. So just to give you again an idea, this is the past 10 years free cash flow, and this is the future counted flow projection of the actual free cash flow for Alibaba. So beyond that, obviously, we're looking at that 2%. Now, obviously, as money devalues, we have to give it a discount, and that's why we give it an 8% discount across the board, just to give you a quick idea of how we do these calculations. Now, we are assuming that the revenue growth will only be about 2% at this moment. Now, it could be higher than that. You can actually put it at 3 or 4%, which would give you around $143 a share. I don't think it will go any further more, even if you opt it maybe to 5-6% to about 150 intrinsic price. It would still be, as far as I'm concerned, a minimal value discount on the share price, and I think at this moment, for me, this is slightly overvalued. Now, it still doesn't mean that it's not a good entry point if you guys think that there's further growth in the company. Do we, that's one of the situations, but that is currently where we're at in terms of that. Now, there's a net debt obviously on top of that, which is about $22 billion, which is a bit concerning. So that's something also to bear in mind. So I think 132, I think 127 is about right for the valuation. So it's still a high business quality business. As I said, the DCF suggests it's a fair value. So you should definitely monitor the situation with that and the China macro recovery, regulatory environment, and margin expansion. So that's something to bear in mind for there, guys, on that side. Now, we do know that on average the growth has been 19%, but it has slowed down in the past few years, and I think we're being some people may well think that I'm conservative. Please do make comments below if you think that the growth of Alibaba may be much more than that. But as my opinion and my calculation, I think 127 to about 140 is possibly where the true valuation of the stock price is. So let's move on to my final thoughts. Now, obviously we've gone through the plus and minuses, we've gone through the fundamentals, we've gone through the DCF model, we've gone through the actual ecosystem and what Alibaba does, of course, as a starting point. I think we've already established my final thoughts in terms that it is a very, very good, high quality business. Absolutely no doubt that's a massive tick. It has massive options on AI, which I think is going to get bigger and bigger, especially with the Asian market. And I think that is definitely going to be trading at a very attractive, it's going to make the trading very attractive in terms of moving into that, in terms of that business side. So the opportunity is significant. I think that you have to have a very high tolerance for it. I think you are exposed to a massive AI and cloud boom. By the same token, you are also exposed to the geopolitical situation in China and what the Chinese might do in terms of going forward with this company. There's always governed by obviously a very different political system in China. It has a huge amount of competition. Even so, the moat is very, very strong. And we are in an uncomfortable regulatory situation. Now, the geopolitical and tariffs as well could affect the company going forward. That's something to bear in mind because there's obviously the Chinese and the US can be very up and down, although the last meeting and summit was very successful from what I can gather. Slowing Chinese macroeconomy also is struggling. It's struggling at the moment. And profitability sacrifices for growth, as it says there, aggressive spending to defend its turf. Capex convictions, it says, is around $50 billion going forward for new infrastructure in 2028. Due to the complex legal structure used by foreign investors to buy Chinese stocks, permanent risk is at discount. It baked into Alibaba. It may never achieve the high valuation multiples enjoyed by the US tech companies. That's also something that should be definitely there. So for me, it's probably not an investment at this moment. I think worry for me really, I think, is the geopolitical situation in China. You just are not in control of that stock like you are potentially in the US. Now, I'm not preferring anybody specifically. I'm trying to stay as neutral as I can, but US regulation is obviously a lot less than Chinese. I think that there is some discrepancies in terms of a slight fallout in profit over the last 4 or 5 years. I think the fundamentals are still strong. However, the share price for me is also overvalued. It's not something I would go for. You know, I'm sure you guys, if you've been following me, if not, you haven't, and you're new, that my minimum criteria for a margin of safety off its intrinsic price is 25%, and it's nowhere near that. So for me, it's a no for now. It will go on my watch list because I think it's a very good company. Nevertheless, it will grow over the next 10 years. Is Alibaba going to be around for the next 10 years? Absolutely. It will be a dominant player for sure. It just needs to wait for the right structure. So that is where I'm at. Now, let's have a quick look potentially at the share price weights. So looking at the share price, this is a 1 year chart, as you can see. So interestingly enough, the beta, by the way, is under 1. So it's not a volatile stock in terms of market comparison. And the P ratio is moved up to about 20 currently, which is slightly higher than the number I just gave you there, which obviously was based from end of March. So we have got an earnings up. The earnings update was pretty positive on the last one, although it did take a bit of a punt down there. But as you can see there at the moment, the share price is in that mid-range. It obviously went as far up to 180 a share. As you probably remember, I mentioned last year that the share price was around 100, 106, which is where I thought initially there was actually a discount, a fairly good discount based on its intrinsic price. But since then, obviously, it's moved back up and has a fairly turbulent side, but currently in mid-range at 129. So based on that, if you look at the intrinsic price of what we're looking at here, we're looking at maybe 150 to 140. If that's you want to expand on growth above the 2% mark that I came up with, which I kind of put down, still only about 5-10% discount. It's still a discount. So if you guys think that it's going to grow above 4% in growth, then by all means that might be a lesser tolerance for you guys. But my tolerance for me is that if the stock price falls quite hard and I've got a 25 to 30% discount already on the intrinsic price, it will hurt a hell of a lot less than it will at this moment. So that's my reason why an MOS of 25 to 30% I think is very important if you were to look at it that way. Even if it's for short-term or medium or long-term buying, if you can maximize the two together, the value investing process with a company you like already at discount, then if you're going to buy it for maybe 2 or 3 weeks or a month, at least if it falls badly, you are already protected slightly. So that's where I'm mixing the two strategies together. Finish this off, I think really anything between $90 to $100 a share is probably the better watermark to do an entry point on Alibaba, and that will give you at least 20 to 25% discount off the 140 mark intrinsic price, or even 127. Even at 127, if you were to look at that, I think 85 to 90 would be probably a better entry point. So there you go, guys. I hope you enjoyed this analysis. It's not a deep analysis, but it gives you an overall idea of Alibaba and if it's worth an investment. But for me at this moment, it's a no, and it goes on my watch list for around $85 to $90 a mark. So if you do agree, please make comments. Always happy to have further comments on my analysis, whether you agree with me or not. And obviously, please subscribe and like that. Quick look at the news for the week, because things are moving in certain directions, obviously, and give you a quick update on my portfolio as well before the end of week. So guys, let's have a quick look at the news. We've had obviously Nvidia last night announcing their results, so let's go straight to that at the moment. I'm sure you guys already are well aware of the results. Very good numbers again. Forward guidance was very good as well. I think that obviously there's an AI boom with the amount of expenditure from the big seven. Clearly Nvidia was always going to have good results. The big problem will be, of course, if there's a slowdown in expenditure, capital expenditure, eventually by the Mag 7, where will that leave Nvidia's numbers? But again, another huge spike there of AI boom, 85% from a year on a year, 81 billion, outpacing analyst expectations. So again, fantastic. Now the share price did not pop. I think the expectation is so high now on Nvidia every time. It's almost like a fair, like almost like the market has completely gone mad in stopping and obsessively with Nvidia and the results every quarter. It's like a big party. But this one, the party did not pop. It was damp squid, if you ask me. It's only up about 1.5%, although it may well give a bit of a boost to the markets to start off with. Right, so we're looking at the markets here at the moment, and it's looking pretty much pretty much comfortable in the green in pre-market. US 30 up 33%, 0.33, 165 points, and the Nasdaq up 122. I mean, let's not forget that these two are absolutely on a tear at the moment. It is quite frightening, the fact that we are moving so fast, so quick, so high to all-time highs. You've got to think, when is that crash going to come? So something to be aware of at some stage without sounding the voice of doom. In terms of the actual portfolio, I sold my position in Marks and Spencer's for a profit just before their results on Tuesday night. They did have not bad results, even though they had a cyber attack. For some of you that may not know, Marks and Spencer obviously is a grocer slash a retailer in the UK, and sold it for a nice profit. I bought it at 314 and sold it at 333. Position in Netflix, guys, as well at the moment. Have a quick look. So just for clarity here, so to show you that I'm not lying of anything, Netflix. So I've added my position to an extra 1,500 shares, and I'm now over just under 4,500 shares, and I've averaged out my price at 89.93. I bought initially the first tranche at 91. Feeling confident that Netflix will bounce back towards the mid-90s at some stage, and this is more of a patient play and see what happens next. But again, Netflix came up with some very positive numbers recently. Even so, yes, the takeover didn't take over of Warner's, and I think this will potentially pop towards the mid-90s, and I can then take a lump. I'm back into Meta as of yesterday. I bought in at 604.90, 6,000 shares, which is the minimum I could buy at this moment. As you can see, minimally down in the red at the moment. So again, patient player. I feel that Meta is massively undervalued. Both Netflix not as much, but Meta in terms of my valuation is easily 26% at discount. So worth a buy there, I think, for Meta. Again, do your own diligence, but I think Meta still has a huge potential. They've unfortunately just got rid of 8,000 people and replacing 7,000 people. So that made the headlines for the last few days. And we are definitely going into a very scary AI world there, where people are now starting to lose their jobs on a mass situation, which is never a great thing to hear from anybody's point of view, being a human myself. Down to 105. Yes, guys, I'm short on oil. Finally, a bit of a break. Will there be a break in the negotiations with Iran and US? Now, apparently, it's looking likely, by Mr. Trump says. We've heard that before, so I'm not going to get too overly happy. But the crude oil has dropped nearly $7 since Monday. So that has certainly helped my account value and also my position at the moment on crude oil, which is down 300 quid. I was down maybe 500, 600, 700 quid again, for clarity, because this is what it's all about, this channel. It's not the glamour life of a millionaire. It's about being patient and making profit when you can. Down to under 90, which is where I bought my position. I've got a position at 192. Anyway, it is what it is. Let's see what comes out next. Adobe, not much changed. Was at 264. Yet again, dropped massively back again. Short-term buyers probably pushing it and then dumping it, or pump and sell, pump and dump. But at least it's found a floor at 250. So let's see if it can bounce back eventually. But as you can see, quite a bit in the red there on that side. Please do leave me comments below, especially on the Alibaba analysis, or any idea on any comments on the news and what's going on. I'm also have asked you guys, if you can, to let me know if there's any company you want me to look into in terms of analysis. Always happy to do so. But I thought Alibaba was a little bit different, as not a lot of people have done it recently, and it is still a very good company. But as I said, not for me at this moment. So from one retail investor to another, this is Trader 72. I hope you enjoyed, guys, and on to the next one. I'll see you soon, and let's keep an eye on that market, because it is hotting up, And I think today will be quite an interesting day in terms of what will the market do on the back end of Nvidia and the Iran-US peace war. We know, so by the way, before we go, that the bond market is quite hot at the moment as well. So be aware of that because that is all connected to stocks and shares. All right. Take care, guys. See you soon.